Hey everybody, interest rates are up and they are, look as high as I think I've seen them in a couple of decades. So I wanted to run through all your choices out there for fixed rate investments and run through some of the critical issues with each one, but then show you the interest rates that you have. So fixed rate investments. We'll talk about bonds. We'll talk about treasuries, all the different choices you have out there real quick in a quick little rundown, concise. So if you're looking for some safe investments, locking in some of these higher interest rates, it is a great time to do that. So let's dive in. Fixed rate choices. What are all your choices? Well, the first one is bonds. We all know what bonds are. It's on in almost everybody's portfolio. It's pretty much your only quote unquote safe, stable investment in your 401k. And so we've got that as a choice. The problem is that does come with a version of market risk. It's interest rate market risk primarily. Now, there's some other risks, risk of default, risk of lowering of their grading, double A, triple A, so forth and so on. And then most of these people don't understand their simple interest. Some other things like they're callable, things like that. So if you need money, you have to go to the market and sell shares or portions of your bonds and take what the price will bear. That's why they have market risk if you need the money. Now, you want to wait till maturity. You have no risk from market fluctuations. You certainly still have other risks that are out there, but not from, interest rate environment or anything else. Okay? So, bonds are a choice. Preferred stocks, a lot of people forget about these. These are fixed rate dividend payers. So these are a strange little hybrid between regular common stock and bonds. Okay. So think of these as just stock, but they pay a fixed dividend rate, and you get paid that dividend before the rest of the people get paid their dividends. So they come with a unique market risk, I like to call it. Okay. So they act a lot more like bonds, but they do still have an element of the performance of the company, the stock performance. It is not going to move like its traditional common stock, but the fact is that that is still there. Certainly, there's still default. There's lack of diversification is the other problem. Preferred stocks, the reality is they're mostly financial companies. And that's why when 2008's crash happened, preferred stocks crashed hard and they never actually really came back. So, a little hard to diversify. You can't put all your eggs in that basket. That creates more risk. And it really came out in the 2008 crash. But the cool thing about these is most of these are US companies paying these, and these are considered qualified dividends. So, from a tax standpoint, they can be tax advantaged in the right part of your portfolio when used properly. So, they've got a lot of good and bad to this. I like using them as a diversifier for a yielding portfolio to enhance my dividend portfolio. And most of these are callable. So, they don't want to pay you some higher interest because they don't have to. They can just stop paying you and give money back. Then there is treasuries. Well, the reality is most of these, believe it or not, have market risk unless held to maturity. They're very much like bonds. And there's so many different treasuries that we have out there, whether they're the short-term ones or all the way out to the 30-year bonds. The reality is the vast majority of them have market risk. If you want money from these before the term's up, you have to go to the open market and sell them. There's a couple of choices out there that you can redeem them directly from their treasury before maturity, but sometimes those will come with penalties. So understand that treasuries are a little bit cumbersome. Some treasuries you can buy in brokerage accounts, some you can't. The ones that have no market risk, you can't buy in a brokerage account. You got to buy them directly through the treasury. So lots of choices, long term all the way down to short term. And when I say short term, ultra short term, all the way down to weeks. Then there's CDs. Everybody knows about the bank CDs, mostly simple interest. Okay. No market risk. That's the appeal. Whereas you look at bonds, preferred stocks, treasuries, these all come with some form of market risk. Now, again, there's a couple of exceptions in the treasuries. Short terms, longer terms are usually callable. So think about this. You have no market risk. You're typically earning simple interest. Some of the newer stuff, there's a handful of them out there paying compound interest. But when you have the shorter terms, you don't really need access to this money if it's a 6 month CD. But that's why they are built this way. They push you into these shorter terms, and historically, you're going to get paid less interest. And then you just flip it into the next CD, next CD, next CD, next CD. So the banks get to invest the money for the long run because they know they're going to keep the majority of that CD money. But you're going to keep getting paid the shorter term interest rates. So we got to build these in a way where if we're going to need access to the money, if we don't want to pay the penalty, then we need to ladder them and pay attention to the terms. Because if we go try to lock in longer terms with CDs, they're usually callable. So if interest rates go down, those longer term ones put the callable option on there so they can say, hey, interest rates are only 2% now. I'm paying you back and I'm not going to keep paying this interest. For longer terms, MYGAs, multi-year guarantee annuities. There's that scary word for a lot of people, annuities. But the reality is some $250 billion a year are getting put into this specific type of annuity. These have been the most popular ones for obvious reasons. They're just CDs from insurance companies. They don't have the market risk, just like CDs. Mostly compound. Now, the new generation, there's some newer ones out there flashing higher interest rates that are simple interest. So by default, MYGAs are compound. By default, CDs are simple, but they're starting to blur the lines between the two. The big difference here is MYGAs, the insurance companies are focusing on longer term fixed rates. So they build in access to these accounts so you can take money out and spend it. They're making them more user friendly, especially for people in retirement. So these are all built for different reasons and different uses in your portfolio, and making sure you're using them properly becomes very important. So let's take a look at all this. So when we say market risk, we need to understand the general idea of interest rate risk. If interest rate rises, the value of bonds goes down. If interest rates then go down, the value of your bonds goes up. So that's the market risk that we're talking about, not in general stock market ups and downs. We're talking about interest rate ups and downs that affect three of these investments more than others, right? So bonds, classic. If interest rates go up like they did in 2022, you're going to lose a bunch of money in your bond values. You wait till maturity, you get to collect back the full value of it if you bought it brand new. If you bought it used, who knows what you paid for it because you're typically not paying par. So you look at the interest rates out there, the AAA all the way down to single A, corporate versus municipal. And you can see the interest rates that we're looking at here. So fours until you start hitting 10, you start seeing the fives, and then the sixes come in the 20 and 30 years. Okay. And then municipals just pay less, period. They have the incentive of being tax-free. They don't have to pay you as much interest. So if you're not in the higher tax brackets, you have no reason to be looking at these municipal bonds. Those of you in the 12%, 10% tax brackets, corporate bonds are significantly better right now. So sometimes they'll blur the lines a little bit, but right now it's pretty obvious. You got to go out 20, 30 years to get the higher interest rates in the sixes. Okay. And again, that means if you're going to need money in the next 20 or 30 years, you're going to have to go to the open market and sell it. If interest rates are lower, then the value of these investments will be higher when you go to sell it. But if interest rates are higher, they're going to be worth a lot less and you're going to take a hit. So you have market risk. Treasuries, again, the reason there's market risk is because of the interest rate risk. If you need access to the money before its maturity, then you have to go to the open market and sell them. Again, there's a couple of exceptions out there in the Treasury world, but the vast majority of them have that market risk issue. So you look at these treasuries and these ultra short-term type treasuries, there's no reason you would need to go sell those in the open market. So you shouldn't really have a problem with interest rate risk there, but you start going out to the longer terms. And again, there's 20-year, 30-year treasury bonds as well. It just cut off from a size standpoint, but they don't change much. After 10 years, they go pretty flat. So 4.5%. And pretty flat interest rates all the way down to 1 year at 4.12. Look, you don't have very much risk at all when you're getting into treasuries. The only risk is the interest rate risk if you need the money before maturity. You don't have a perceived default risk, let's just say. So they don't have to pay you as much. That's just the reality of it. And then there are preferred stocks. Preferred stocks are, again, often overlooked for fixed rate investments. It's a great diversifier in a dividend portfolio. A lot of these can be qualified dividends when used properly. The ETFs and mutual funds are ranging anywhere from 6 to 7% yield out of there, dividend rate out of there. But you can put together individual stocks and you'll see ranges anywhere from 4% on up to 9% is typically the higher end. Kind of like the publicly traded REITs, you'll find the same thing. Now, again, publicly traded REITs, they're not going to be fixed rates of yield or anything like that. So we got to be careful about those. All right, so those are the market risk based ones. Again, the market risk comes when you choose to sell them on the open market prior to the maturity. If you just wait till maturity, preferred stocks don't really have maturities usually. So a little gray area there. But the reality is the other two, you definitely have maturities you can fall back on. So now let's talk about no market risk. Again, market risk, meaning either interest rate risk or stock market risk or anything like that. Certainly default risk or things like that could possibly happen. A bank can go out of business. Now you have fallbacks on banks and insurance companies. So they're as safe gets, the reality of it. So we look at CDs, the shorter terms, you're pretty safe on those. You shouldn't have any risk on those. You just need to wait the full year to get your money, or 9 months or 6 months. But you can see you're really maxing out in the fours in the interest rate environment that we're currently in. Okay. I am recording this on July 7th. Of 2026, July 7th of 2026. So it's important to understand all these interest rates change every single day, and CDs are absolutely part of that. This is in general what we're finding out there from a CD market. So primarily in the fours, whether you're investing for 6 months or all the way out to 10 years, just understand the further out you go, the more likely it is callable. And some of these don't even have what they call death puts, meaning if you pass away, the heirs still have to meet the term too. So you got to be careful about some of the fine print on these, believe it or not. Then there's the MYGAs, multi-year guarantee annuities. These are literally just CDs from insurance companies. So I broke them out into 4 different categories and then 4 different main terms that they have. Terms meaning 3-year, 5-year, 7-year, or 10-year. That's the typical terms that they do these in. Are there 2-year? Are there 4-year? Are there 6-year? Are there 7, 8, 9, whatever? Yes, there's all of them, but the vast majority of insurance companies do 3, 5, 7, and 10. Now, the new anomaly out there is simple interest. So with access, compound interest, you're looking at 5.45, 5.9, 5.9, and a 10-year all the way out to 5.9 on compound interest. The highest I ever saw it with access to the money, meaning you're allowed to reach in and take money out of there all along the way every year. That's kind of nice, right? You're going to have access to this account with the guaranteed interest rates for 3, 5, 7, or 10 years. I saw compound 6% with access to the account. That's the highest I saw interest rates get after that 2022 rise. Other than that, you got to go all the way back to the 90s, the late 90s, but since we've seen interest rates like this. So we're pretty darn close, and there's the 6%, but this one doesn't give you access. So without access, acting just like actual CDs, that's this bottom section. So I make people aware of this because, boy, from a sales gimmick standpoint, if I flash out there, I've got 7-year fixed at 6.8%. And I don't tell you that you have no access to the money, and I don't tell you that it's simple interest, I'm going to attract a lot of business, right? And I don't like these sales gimmicks out there. To me, that's a sales gimmick. There are far and few between that this makes any sense for, right? 6.8% sounds wonderful, but when you realize you don't have any access to the money and it's simple interest, it doesn't really compare, certainly to the 6% compound or 5.9 with access or 6.15 simple interest with access. The cool thing about simple interest, especially for retirees, is if you're actually going to use some of this money and make withdrawals, simple interest is great. There's nothing wrong with it. It's for the people that don't need their money at all and it's just going to sit there and compound its growth that you want to focus on these compound rates. And 5.9 on a 5-year, 7-year, and 10 years, pretty darn good to have access to the money all along the way as well. You don't have to worry about market risk or penalties or any of that stuff. They're going to give you access, either interest, so all the interest that accumulates, or 10% is usually a standard out there. So access to 10% of the account every year. So you can make 2, 3 withdrawals. You could withdraw the interest every month. You could do it any way that you want. Set it up as friendly as you need it to be. These are built for retirees to be able to use their money and still have a safe place to stock it away and earn a fixed rate. That's what these were built for. So it's a diversification of these CDs. You want to invest your money for less than a year. Well, CDs are going to be your quick, easy, fixed interest rates. But with money market accounts these days paying about the same amount of interest short term, I don't know if CDs are really worth it, worth the hassle of running around, making sure you're there after 6 months or 9 months or a year, and getting it flipped into a new account, all that kind of stuff. MIGA's still one of the top fixed rate, safe, stable investments for portfolios these days. We've been, 4 or 5 years in a row over 250 billion with a B money inflowing into these things. And it really is logical when you start understanding the choices out there. So that's all the different fixed interest rates, right? That's your 5 different choices realistically to invest money and earn a fixed rate of return. Those are the choices out there. So hopefully that's helpful. It puts some perspective on your choices for your portfolio out there. Obviously, I'm always happy to help out with any of this stuff or answer questions. You certainly can go on to yourinvestmentcounselor.com or our website, sesweb.net, and schedule an appointment directly with me. You can schedule a Zoom appointment, or if you happen to be here in Arizona, you certainly can come in. But I'm always licensed and happy to help out in pretty much every state out there. Full classes. I teach full classes every single month. It's a different topic. Go to our nonprofit organization, fpfeaz.org, to find our full class schedule on there. If you have not subscribed to this channel, you got new videos all the time. Keep up on what's going on out there. I try to create videos anytime I see news that's relevant to the retiree world or soon to be retired world. So lots of wonderful videos. We got over 300 videos and plenty more coming. I can keep them coming. Like, share, subscribe, do all those wonderful things, and certainly contact us if we can help in any way. Thanks again, everybody, and we'll see you soon.